This October is already on track to be one of the worst for U.S. equities since the crash of 1987. So is history just repeating itself, or can things turn around? Joining me today is David Stein. He's a managing partner of Aerecura Capital here in Toronto. Thank you so much for joining us.
Thank you. Thanks for having me.
Obviously, the S&P having a retraction here. David, Goldman Sachs came out saying, hey, folks, this is just a momentary lapse of reason. Things should turn around. You should be in growth stocks. How do you see it?
I can see both sides right now. So it's I think it's a very tough market to trade in or to make a long-term decision in. If you look at the longer-term equities, U.S. equities charts, they haven't quite broken down yet, but they're getting close. And the thing that we all know deep in our hearts is that this rally's been really, really long in the tooth. So I think the risk is very high right now.
Risk is high for a correction, for a bigger correction.
Yeah, for a rollover into a bear market. I mean, I think the markets are due for that, whether it's shorter or next year or whatever. I think no one knows, and typically what happens is there'll be some type of external catalyst that'll kind of get us there. And I don't honestly see what that's going to be right now, but there's still lots of good news that keeps pushing the market higher. But I mean, at the end of the day, valuations are stretched. Companies can't just keep borrowing to buy back stock. ETFs are, I think, are managing way too much of our institutional money now. So there's all sorts of bells going off, but not enough has happened to really cause a correction yet.
So when we speak of correction, is it a substantial one you see could happen? And if so, could you quantify it in percentage terms?
I think it could be very similar to other corrections that we've had, including 2008. I guess it depends on what the external factors are going to be that kind of come out of nowhere and surprise us. But the one thing that one theme that I personally feel is a huge risk factor in the market is how much money has gone to passive ETF strategies over the last decade. Right. The growth of that versus active management has been it's just swamped active management. So when these computers decide to sell, when their models start turning negative, I think it could be quite a panic.
So David, what could this mean for gold?
Well, I mean, I think you definitely want to be holding some gold. People always talk about its role as a diversifier. It also could do quite well in that term. I mean, I was around during 2008, the correction, had a front row seat. After the initial panic, gold did extremely well, and it led the market out of that correction, and we had a really, really nice rally. It ended up being a great place to be. So, I feel like that's going to be gold's role. Silver as well, something I'm very interested in. So I like silver as well. I think you want to own some. Whether it's miners or physical, depends on, I think, where you are in your life right now. But for me, I'm more owning the mining companies right now. But definitely physical is even safer.
Some analysts have brought up the R word, recession. Do you think that's the path we're headed on?
Yeah, I mean that will happen. I think when a correction happens. Again, hard to see what the catalyst for recession is going to be right now, just because everything seems to be going so great. But we're due for one. It will happen in the next 1 to 2 years. That's what I think. Be prepared. Yeah, be prepared.
All right, David Stein, thank you so much for speaking with me on the sidelines of the Minds of Money conference here in Toronto. We'll have more for you on Kitco.com.